So you know, as much as I love to talk about stocks, right? So my friend the other day come to me and say, Mike, I finally sold my shares of BCE and now I'm done with struggling businesses. I'm looking for a dividend grower. And I thought, well, some people are listening to me, right? So I thought, okay, dude, I'm not giving you financial advice, but let's take a look at some of great companies that grows their dividend high single to double digit per year. But I did not want to come with those classic like MasterCard, Visa, Apple, or Alimentation Couche-Tard. I wanted to dig a little bit deeper and find those underrated stocks. So out of that discussion, I was able to find 9 companies with strong dividend triangle that are not your typical play when you're thinking about dividend investing. In this video, we are going to look at 5 of them, but I'm going to keep my favorite 4 for next week. So let's get started with GoEasy, ticker GSY.TO. And don't worry, all the tickers will be down below. So GoEasy, lending business in Canada, focusing on people that kind of had a rough patch at one point so they can charge a higher interest rate. So if you look at the dividend triangle, the stock went on a rampage in 21-22. And then as interest rate rose, everybody got scared and then the stock price decreased and eventually is going back up because why? Well, when you look at the revenue and the earnings, it's kind of like pretty stable. So yes, they had an incredible year in 21 where the money was still cheap and then a lot of Canadians were going after new loans, but moving forward, they are still able to be highly profitable and most importantly, they are now a very strong dividend grower. So their business is quite simple. They focus on the average Canadian that has been declined at least once by their bank. So maybe they're a little bit too much in debt. Maybe they forgot to make a few payments, but in the end, they're gonna squeeze. They want another loan, and then GoEasy is there saying, hey, come here. We know you, we know your situation, and we're able to finance the products you want to buy, but we're just going to increase the interest rate a little bit. So they're making more money than the average bank on a loan, but the fact that they know exactly what their customer looks like will give them a strong advantage underwriting process. So as you can see, the bulk of their business is all about growing their loan portfolio. But this comes with a problem, right? If you're lending to people that already got declined, probably that some of them are not going to pay back their loan. So the business model they have built here is quite smart because since they generate so much cash flow and they make a lot of money on their loans, they are also able to maintain a higher level of charge-off. So like customers that are not paying back and still be very profitable. So the net charge-off will always be around their target between 8 to 10%, which is kind of high, but all the other paid loans are compensating with the high interest rate. So GoEasy's biggest strength is definitely their underwriting process. I've worked in the financial industry for 13 years and I've seen how giving good loans to the good client is profitable. On the other side, the biggest risk is maybe GoEasy looks good on prom night. So when everybody is paying back their loans, we're not in a recession yet, so everybody has a job, so everything is great. But what's going to happen when Canada enters in a recession? What's going to happen when those customers that are already in a not stellar situation get another roadblock, another speed bump, or they lose their job? Well, maybe they're going to have a higher net charge-off, and this is where it could get GoEasy into trouble. So you just have to be careful about this. This is the type of business you must monitor quarterly. So now let's move on with another one, Sherwin-Williams, ticker SHW on the US market. As you can see on this one, has nicely recovered after we had the fear that the construction market may slow down due to higher interest rate. Now it's back in strength, almost trading at a all-time high. Revenue and earnings are pointing to the top, and of course, the dividend looks very healthy. So Sherwin-Williams is the largest architectural paint seller in the US. It can count on selling their paint into their stores for 56% of their revenue. They also count on like wide distribution networks such as Lowe's and Home Depot for another 14%, selling to DIY customers. And they also sell to professionals, which I think is like one of the most interesting part of the business, because professionals will go back to Sherwin-Williams buying their product due to their high quality. They don't have time to waste to try different brands and making sometimes like hit and miss for another type of product, so they will remain loyal, and that create a very solid base of revenue. And this is how the company is able to keep on growing year after year. So of course, the biggest downsides for Sherwin-Williams is the economy. So they rely heavily on their North America segment to generate a lot of growth, and if we go into a recession or if there's like a slowdown in the housing market and the construction market, of course Sherwin-Williams will be hurt by this. They also had to manage with a lot of inflation affecting their margin because of the cost of raw materials. Speaking of raw materials, moving on to the next stock idea I have here, Imperial Oil, IMO.TO, or also trades on the US market for IMO. Vertically integrated oil company, pretty similar to ExxonMobil, that is actually the parent company that owns about 70% of Imperial Oil. This company will go through all the ups and downs of the oil market, but has sustained their dividend payment and increased it for more than 2 decades, which is quite a feat in this sector. One of their secret is, since they are vertically integrated, they are able to make profit at each stage of the development of the oil. The other thing that they do is their stellar capital allocation. So whenever they have more cash flow, they buy back shares, which also helps them to increase the dividend moving forward without having a higher total dividend payment to be made. So Imperial Oil has demonstrated for almost 30 years that it is able to manage its cash flow in a good way by taking care of its balance sheet and controlling their debt, by using the cash flow to buy back shares, increasing earnings per share, and of course increasing the dividend. Of course, the downside is from time to time the stock price is going to take a big hit when the oil market goes down. There's not much you can do about that, but still it also creates great buying opportunities. As you can see so far, those 3 companies have at least 2 things in common. The first one is they show strong fundamentals, so their financial metrics are incredibly solid. And the second thing is, if you look into those tickers, you're going to realize they have low yield. So those low yield, high dividend growth companies are usually the best type of company that you can have in your portfolio, even at retirement. If you don't believe me because you think that you absolutely need to have a high yield to retire, well, I would like to invite you to download the Dividend Income for Life guide, where I explain you why high yield are probably riskier for your retirement, and instead focusing on thriving businesses with strong fundamentals will actually be a much better choice. In this guide, I will also teach you how to build your portfolio and how to prevent not having to sell shares during down markets to protect your capital and ensure that you actually can create your own dividend throughout your retirement. So you can download the Dividend Income for Life guide at dividendstocksrock.com/income. You just have to put your name there. You're going to be able to download it. I also provide an example of a portfolio and what it could look like. And finally, the guide will be updated in the next 2 weeks. So if you subscribe to the newsletter to download the guide that was created last year, well, I am working right now on an updated version that will be sent to everyone that subscribed to my newsletter by the end of October. So now moving on to number 6 on my list of underrated dividend grower, Lam Research, ticker LRCX. As you can see on the dividend triangle graph, Lam Research is going through ups and downs as the company is quite cyclical. So you see the revenue and the earnings. Sometimes it's going well, sometimes not so much. So you have to be prepared to ride a roller coaster. So what Lam Research does? Well, it is the largest semiconductor wafer fabrication equipment. So they are selling the equipment to the big guys such as Intel, Taiwan Semiconductor, Samsung, and Micron. So what's a wafer, you're going to tell me? Well, a wafer is a thin slice of semiconductors. So the equipment that Lam Research sells to those big guys is crucial in the creation of memory chips, and in general, all the semiconductors, which we call the foundries. You can see that they make most of their money in Asia, so China, Korea, and Taiwan. In the event of a tariff war between the US and China, maybe that Lam Research is going to get stuck between both countries. It could hurt them a little bit more, but at the same time, they kind of, like, everybody kind of need those equipment. One thing that I really like about this business is their capital allocation strategy. So they will spend a lot of money on research and development, but then they will use the rest of their money to buy back shares and to increase their dividends. So once again, a low yield, high growth company that has a lot of tailwinds counting on the Internet of Things, data centers, and the rise of artificial intelligence. On the other side, unfortunately, it is quite cyclical. It has to spend billions in R&D each year, so there is a lot of innovation challenge there, and eventually they could lose their place. I mean, we saw how Intel was a major player, a dominant player in the semiconductor business, and today it is a struggling company because their technology edge is not that important anymore. So number 5 on the list, definitely the last one today, but not the least, Fastenal. F-A-S-T is the ticker. So Fastenal, they are selling fasteners. So those little pieces of hardware that are being needed everywhere. As you can see, since we're talking about repetitive purchases over and over, we see that the revenue and earnings are pretty much growing at the same trend, which also create a perfect situation for a company like this to be a strong dividend grower. Dividend triangle is almost perfect. We can see that there's a small slowdown happening in 2024, which is kind of normal because there's still a cyclical business as industries. If they need less fastener, well, there you go. Fastenal will be stuck with a little bit more inventory. So one thing I really like about Fastenal is they have changed their business model to open a lot of on-site locations. In other words, they went to see their biggest clients and they said, you know what, we're going to open your own Fastenal store inside your building, so you don't have to worry about inventory, you don't have to worry about making orders and delays for transportation. We are going to be right here, right now when you need it. So it's highly efficient, but it also creates a sticky business relationship. For smaller clients, they also have vendor machines, which is pretty much on the same principle where the client doesn't have to worry about if the piece of hardware they need is available or not. They have their own store where they can make their purchases. Unfortunately, the business is not perfect. While this strategy was great to counterattack e-commerce, there are still a lot of companies that can order online a lot of stuff that can be delivered in the same day and would not necessarily want to be tied up with Fastenal as having their stores inside their building. The other downside that we have seen as of late is Fastenal is now closing their standalone stores because they are less profitable. So of course they're not going to close all of them, but we can see that there's a discrepancy on how profitable the on-site locations are versus the standalone store. So you have to be careful a little bit about that. But again, nothing is perfect, but so far this one is on for a very strong growth tailwind. So as you can see, while those are interesting businesses, there's a lot more work to be done in terms of due diligence before you pull the trigger. Keep in mind, I'm not giving you financial advice or buy recommendation, but I just wanted to highlight a few companies that looks quite interesting at the time. Next week, we're going to have the top 4, and I own 2 of them, so that's going to be an interesting video where I'm going to put my money where my mouth is. So make sure that you subscribe to the channel not to miss it. I'm going to see you in the comments to see what do you think about GoEasy, Sherwin-Williams, Imperial Oil, Lam Research, and Fastenal, and maybe you can guess what my top 4 underrated dividend growers are. So I'm going to see you in the comments, and until the next video, don't forget to stay invested.